So we have the total fixed asset. The total fixed asset is 97,800. Now here we go. Let's move to current asset side. Current asset. What are the information that is under current? If you look at the format, you see that stocks, we have a closing stock of raw material, closing stock of finished goods, and work in progress. But since we are not giving work in progress, the only one we do here is a closing stock of raw materials, which is 8,400. It is given the additional information, and the finish which is 12,000. That is that. Then we have debtors. If you look at our debtors in the question, we have 19,800, and we also have cash in hand, and that is 15,000. And don't forget, we have prepaid. Prepaid, you know, in SS1 I discussed something on prepaid. That prepaid is something that you have paid in advance, but you have not, that has not been benefit. So it's an asset to you, because since it has not been benefit, you have not enjoyed it, it's an asset. So insurance, you paid insurance in advance, so that means insurance is still owing you. So that 960 is your asset. So we had it. Now let's add it together. 97,800 plus this plus this plus this plus this plus this. You see that we have, if you press the calculator, you see that we have 153,950 at the end of the day. And that is the why you are preparing an account. There must be arithmetic accuracy when you are preparing account. If it does not balance, that means it's not called an account. But if it's balanced, that means you are a true accountant. So you see that every balance sheet has to do with affairs of the company, what the company was, and what the statement position of the company. So that is why balance sheet must be balanced. And if it doesn't balance, that means there is a mistake somewhere. So that is that on the manufacturing, trading, profit and loss account. So that is that. When you are given a question like that, this is the way procedures that you do in doing it. So that's it. Profit and loss appropriation. Anywhere you see appropriation, it's talking about a partnership account. And what is the appropriation is when you are, when you allocate profit to different partners in the partnership business. But before we go to that, what is a partner? What is partnership? What is partnership? Partnership can be defined as the relationship which subsists between 2 to 20 people carrying on a business in common with view of making profit. And you see that the objective of establishing a company is to make profit at the end of the day. So because it must be a profit-oriented company. Now, when it has to do with a partnership is when many people are coming together to form a particular business in view of making profit. So that's what we call partnership business. Now, under it, we're talking about trading profit and loss account. The difference in partnership and trading and manufacturing is that the procedure, the trading profit and loss account to prepare in normal trading profit and loss is also what we are going to prepare in partnership account. But the slight difference here is appropriation. When you get to the net profit, then you are portioned profit to the partners at the end of the day. So that is what is different in partnership. Now, trading profit and loss account are exactly the same that of a sole trader, but partnership will have an extra section called appropriation account. So after preparing normal trading profit and loss account for the partner, then we will prepare what we call appropriation account. And that appropriation account is when you are appropriating the profit to individual partners at the end of the day. And what I want you to know in partnership is that you know they have a partnership deed, which is rules and regulations that guide the partners, how they share the profit, how they contribute the capital, how they pay salary and the likes, and it is binded in the book which all partners have access to. That is a partnership for you. So all partners are entitled to profit once they contribute capital into business. That is the definition, that they come together, carrying pulling capital together. See, relationship between people carrying on a business in order to make profit at the end of the day. So what binds them, how they share the drawings, how they draw account. Maybe there is interest of capital, there is interest of drawing. Maybe when they input capital, when they put capital into a business, they will have interest on capital annually. Or when they draw some amount in the business, they are going to pay interest on that drawing. So that is what our partnership account is talking about. Now, the area aspect that we want to lay emphasis on is that profit and loss account. Since we are familiar with the trading profit and loss account, that is also how they prepare trading the other account. So the first thing is you first prepare trading profit and loss account, which we have done in SS1, and we've also done it in SS2. So we'll be talking about appropriation account here, whereby you bring the net profit down to the credit side of the profit and loss appropriation account. Where the net profit you prepare in trading profit and loss, you bring it down at the credit side. Then there are some information that are also involved, that is the interest on drawing. And you know that we are guided with double entry principles. The same thing also applies to appropriation account. Interest on drawing is on the side of the partner. That means when it must be in their deed. That means partnership deed, that when a partner draws some amount from the company, they have to pay interest. And when they pay interest, you see that money comes in for the company. That's the reason why it is credited in the appropriation account. So we see that there is no something that can mistakenly convince you here. Everything is strictly with procedures and concepts that guide most of the preparation, and that's why it is increased, because it is interest on drawing on the aspect of partners. It is another additional profit, additional income for the company at the end of the day. Now on the debit side, we have the interest on capital. That means it is the company that will pay interest to the business, to the partner, and we illustrate here as Ojo and Ajayi, and Ojo is illustrated in partnership there on the format. So it is the company that will pay out of the profit as interest on capital. So that means the amount that they contribute depends on the interest they pay. Most of the time it is on the fixed rate. So it is on that rate that they give them interest on capital. So it is restricted to the capital they contribute to the business. So they pay out. Then another one is salary. In partnership, you know, most partners, most of them, they are not active. You know, we have different type of partners. You must have done that in the commerce and the economics. We have the sleeping partners, we have a dormant partner, and we have limited partners and many others. So when we are talking about active partners, that means part of the partners are taking active part in the running of the business. So aside that they are entitled to the profit of the business, they are also entitled to be paying salaries to them because they take active part. But most of them are not. Some are dormant. Some are not taking part in the activities of the business, and they have access to profit. They only have access to profit at the end of the day. But those people that are taking active part in the business, which are part of the partner, they are entitled to salary at the end of the day. So at the end of the day, you find the difference. When you find the difference, then you share the profit ratio. So each partner will get his own profit from the business that is being done at the end of the year. And the share of profit has a ratio. Depend on the ratio and depend on the question. You have to follow the question. If it is 2 to 1 ratio, that means 2/3 and 1/3, which is given here. So this one is ratio 2 to 3. That means Ojo has capital more than Ajayi. So the ratio as the share of profit ratio will be given in the question, of which it has to be followed. So that is that appropriation. Then after appropriation, you know there's something accounting has a logic in ways whereby when something has a debit side, it must also have a credit side as well. You know that when you are running a partnership business, you must have a current account at the end of the day. So that is what brings us to capital account and current account. So they must prepare capital account and current account. That means current account is the profit that is given to you, that is apportioned to you at the end of the year, will be transferred to your current account. Now, before we go to current account, let's quickly trash our capital account. Capital account, as we all know, is the amount contributed by each partner into the business and will be credited to his capital account. So, having the capital account, they must also have current account. Capital account is just amount that is being contributed by each partner into the business. And that is why. So, firm can maintain or use either fluctuating capital